It's one of the oldest arguments in economics. If you reduce taxes on the wealthy, the investors, the business owners, the people with capital, they'll invest more, hire more, and grow the economy in ways that benefit everyone. The money flows down. Rising tide lifts all boats. It sounds logical, and for roughly half a century, this argument has been highly influential in major U.S. tax debates, particularly within conservative economic policy. The question is whether the evidence supports it. On July 4, 2025, President Trump signed the One Big Beautiful Bill Act, an 870-page law that made sweeping changes to the American tax code. It is one of the largest recent extensions of supply-side tax policy, making much of the 2017 framework permanent. And the distributional math inside it is specific enough that we can examine in real time how the benefits and costs are being allocated. But to understand the case study, you first need to understand the theory. Supply-side economics argues that taxes and regulation can influence incentives to work, save, invest, and start businesses. When marginal tax rates or the cost of capital fall, proponents expect more productive activity, greater investment, and eventually higher output and wages. Critics often call this trickle-down economics because many of the immediate tax benefits accrue near the top, while the promised broader benefits depend on later economic responses that may or may not materialize. The policy prescription follows: reduce taxes on corporations, investors, and high earners. Reduce regulation. Allow capital to accumulate among those most likely to deploy it productively, and the broader economy eventually benefits. It became highly influential during the Reagan administration. In 1981, legislation reduced the top statutory individual income tax rate from 70% to 50%, with later reforms lowering it further while also changing the tax base. The Tax Cuts and Jobs Act of 2017 lowered the corporate rate from 35% to 21%, a change that was already permanent, and reduced individual rates along with creating new business deductions. The One Big Beautiful Bill Act, signed in July 2025, permanently extended many of the individual provisions of the 2017 law that were scheduled to expire at the end of 2025 and added or expanded other business tax benefits. Now here's the empirical question. What does the evidence actually show? A study by economists David Hope and Julian Limburg examined major tax cuts for the wealthy across 18 developed countries between 1965 and 2015. The research, published in the peer-reviewed journal Socioeconomic Review, found that these reforms significantly increased the income share of the top 1%, while producing no statistically significant effect on GDP per capita or unemployment over the following years. The authors concluded that the cross-country evidence finds little support for broad claims that major tax cuts for high earners reliably produce faster growth or lower unemployment. Proponents of supply-side theory have responses to this research. They argue that the studies don't adequately account for the counterfactual: what growth would have looked like without the cuts. They argue that particular tax reforms in particular contexts do generate investment responses even if average effects across many countries are hard to detect. They point to the period following the 2017 TCJA as evidence of business investment and economic expansion, though economists debate how much of that expansion was attributable to the tax changes versus other factors, including the broader global cycle. These arguments are not fabricated, and the debate among economists is genuine. Even if the law raises aggregate output, that alone would not determine how evenly the gains are distributed, or whether the additional growth is large enough to offset the fiscal cost. Those are three separate questions, and supply-side advocates and critics often speak past each other by addressing different ones. What is less disputed is the distributional outcome over the past several decades. Federal Reserve data beginning in 1989 showed that the top 1% of households, ranked by net worth, increased their share of total household wealth from roughly the low 20% range to approximately 30% today, while the bottom 50% of households collectively hold only about 2% to 3%. These are wealth-based rankings, which overlap with but are not identical to the income-based rankings used in tax distribution analyses. Now here's where the current case study gets specific. The One Big Beautiful Bill Act permanently extends many individual provisions of the 2017 Tax Cuts and Jobs Act that were scheduled to expire, including lower individual income tax rates and the deduction for qualifying pass-through business income, which primarily benefits eligible owners of sole proprietorships, partnerships, S-corporations, and certain other pass-through businesses. The law also expands the estate tax exemption, allowing wealthy families to pass on more assets to their heirs without federal tax. According to an analysis by the Institute on Taxation and Economic Policy using Joint Committee on Taxation data, the top 1% of earners could receive roughly $1 trillion in tax reductions over the decade. Relative to previously scheduled law, ITEP estimates that the top 10% of households would receive an average tax reduction of more than $14,700 per year, while the top 1% would receive reductions exceeding $50,000 per year. These are income-based rankings, different from the Federal Reserve's wealth-based figures, and the estimates reflect specific projection years, so the annual amounts vary across the decade. At the same time, the law substantially reduces projected federal spending on Medicaid and SNAP food assistance. CBO estimates that the enacted Medicaid provisions will reduce federal deficits by roughly $887 billion over 10 years and increase the number of people without health insurance by approximately 7.5 million in 2034. Though losing Medicaid enrollment and becoming uninsured are not the same thing, as some people may find other coverage. The SNAP provisions are projected to reduce participation by roughly 2.4 million people in an average month. CBO's analysis of an earlier version of the legislation found that lower-income households would lose resources largely because of Medicaid and SNAP reductions, while higher-income households would gain from the tax provisions. The general distributional direction of the enacted law is similar, though exact figures may differ. It's worth understanding precisely why the provisions marketed most broadly as working-class benefits, no tax on tips and no tax on overtime, don't deliver equally across the income spectrum. They are structured as deductions rather than refundable credits. Because deductions reduce taxable income rather than provide refundable payments, their value generally rises with the amount of eligible income and tax liability a household has, subject to the provision's limits and phase-outs. Tips and overtime also remain subject to payroll taxes. This isn't a flaw unique to this legislation. It's a structural feature of how deductions work. But it means provisions marketed as universal benefits are not, in practice, equally valuable across income levels. The law is projected to add approximately $3.4 trillion to the federal deficit through 2034, according to CBO's estimate relative to its January 2025 current law baseline. That baseline matters, and this is one of the most underreported parts of the entire debate. Current law accounting treats the scheduled expiration of the 2017 provisions as real, meaning the baseline assumes taxes would have risen at the end of 2025. Current policy accounting assumes Congress would probably have continued those provisions anyway. Neither baseline changes the law itself. They change what it is being compared against. Supporters tend to use the current policy baseline. Critics tend to use the current law baseline. Both are defensible methodological choices, but they produce dramatically different headlines about the same legislation. Larger deficits can place upward pressure on long-term borrowing costs, which can influence mortgage rates and business financing. Credit card rates are driven more directly by short-term benchmark rates and lender pricing, so the connection there is less direct. The magnitude of any interest rate effect is genuinely uncertain. Supporters of the legislation argue that the spending provisions improve work incentives, reduce improper enrollment, and shift program responsibility more appropriately to states. They argue economic growth generated by the tax provisions will create jobs and raise wages that benefit workers across the income spectrum. They argue that making the 2017 provisions permanent gives businesses the long-term certainty needed for investment decisions that take years to play out. These are legitimate arguments about efficiency, incentives, and growth. They don't erase the distributional result, but they argue it is justified by other benefits that take longer to measure. The immediate distribution is clear. The tax provisions deliver larger dollar benefits toward the top of the income distribution, while reductions in Medicaid and food assistance are concentrated farther down. Your specific result depends on much more than income alone: filing status, dependents, business ownership, state and local taxes, health insurance coverage, and eligibility for transfer programs all determine where you land individually. Households with substantial taxable income, business income, or estates generally receive more from the tax provisions. Households that lose Medicaid or SNAP assistance may experience a net loss, even if they also receive a modest tax reduction. What is not yet clear is whether the resulting investment and growth will be large enough and broadly distributed enough to justify that trade-off. The law provides a major new case study, but not a controlled experiment. Its effects will unfold alongside changes in monetary policy, technology, energy prices, and the broader business cycle. Its structure gives us a clear distributional picture immediately. Its growth effects will take longer and will be much harder to isolate. History gives us reasons to be skeptical, but this law's full economic effects cannot be measured on the day it is signed. The real test is not whether wealthy households receive more resources from this legislation. They do. The test is whether the rest of the economy eventually receives enough additional jobs, wages, and productive investment to make the cost worthwhile. That answer will take years to arrive, and when it does, most people won't be paying attention.